Howdy. Welcome back to Dion Talk. If you're watching this in Futureland, it's because I was doing the intro to a long video and I thought that this was probably going to be good enough to release on its own for those people who would never click on a 2-hour video. At Tuesdays at 4 p.m. Pacific, I do a video that lasts as long as the questions do, usually around 2 hours. And recently, because I still consume a lot of content on YouTube University on many different things, I was watching a channel that I enjoy called Joe Kuhn, Kuhn. He invested in stocks to retire early. I invested in real estate, kind of a divergent form of investing, so you would wonder why I watch him. But he retired at 54, and I was looking at retiring at 52. So I started watching his content, and I can honestly say Joe's content contributed significantly to me retiring early. So thanks, Joe. What I got wrong on my YouTube channel. I am making this video because Joe did this, and I thought it was a stroke of genius. So again, good job, Joe. I thought, let me do what Joe did. He went to AI, right? The evil overlords that in the future have to remember that we were very nice to them and should treat us good, and said, what did I get wrong with my YouTube channel? So I went and I structured a prompt. I think I said, I'm just going to read it for word here on some of these. Please review my YouTube channel, Dion Talk Financial Freedom, and tell me things I got wrong. So the response is, here's the things you got wrong. And I'm going to go through them and think, was I wrong or should I clarify? Because if ChatGPT thinks I got it wrong, it'd be pretty easy to misinterpret that. So the first thing it does is it says, now if you've not used AI before, it actually goes through a logic chain of telling you what it's doing to find the information. It thought for 9 seconds. It took 9 seconds to review all of the videos from 4 years of content. That's pretty sad. So 9 seconds later, it spits out, here are areas where Dion's channel tends to oversimplify and may mislead. I want to be transparent. I'm just going to read these. I actually suggest go to ChatGPT or your chosen form of AI and ask the same question. What did Dion get wrong? Because I had a stroke of genius just before the video and I didn't have time to read it all. But I went to ChatGPT and I asked it to review a Crash Bro channel with a very specific prompt that at the end of this video, I'm also going to read because I have a sick sense of humor. First thing that I got wrong, lazy real estate investing equals no effort. So after reviewing 4 years of video content, ChatGPT came back with the idea that I say it takes no effort to invest in real estate. Again, this is an attempt for me to improve my content because if this can be misleading, I don't want to do that. I do say investing in real estate is life-consuming. Owning real estate is close to passive. It's not iron lung passive, right? It takes me a couple hours a month to manage my 18 rental units, but acquiring those, even though in the beginning it was only one every 2 years, the thousands of hours of self-education that went into watching one rental at a time in BiggerPockets and listening to audiobooks, definitely not passive, definitely not no effort. Learning the skill to analyze a deal, to study a market, to figure out an asset that I initially wanted didn't work and had to switch my market asset type was a ton of work. So if I've been misleading, because I call myself the lazy investor, I literally have a book coming out called The Financial Freedom for the Lazy Person. That's not the goal. The goal is you need to be the right kind of lazy. A lot of people focus on 5 days of action for that 2-day weekend. They call it work-life balance. I want you to focus on a decade of suck to get all of the rest of the decades never having to work again. So, word for word. You present real estate as the lazy path to wealth, but your journey involved intense work, improving debt to income ratio, house hacking, deep research learning, systems, and just 2 years for the first duplex. Viewers may underestimate complexity and upfront commitment needed. Fair enough. I have done many videos where I try to clarify that. Guess I'm going to have to do a better job. The second one, ignoring market risks and economic cycles. I get this. How many times have I said in my videos, if you're new to my channel, enjoy hearing this for the first time, there are only two things that tell us when to buy. And it's not interest rates, it's not prices, and it's not rents. The first thing is, are you ready? Meaning you've studied your market, you have the reserves, the down payment, the closing costs, you understand your asset class, you know how to recognize a good deal, and you don't have anything major going on in your life like birth, death, or divorce. That's the first thing. And the second thing is, did you find a great deal? Because I'm talking about buy and hold investing. Now, if Skippy the Magnificent, my AI bot, reviews my entire channel and thinks of all investing, and I'm saying to disregard market trends or an expected crash, like the video I'm going to talk about at the channel at the end of this video, I get it. I've gone back through all of the years of my life and I've tried to find a year where I wouldn't have wanted to buy a deal. And the best example I can come up with is 2008, just before a 4-year crash, where some markets went down 75%. Would it make more sense to wait and buy 75% less? Sure. But the buy and hold investors that bought in 2008 actually benefited, as long as they didn't have that adjustable rate loan and were over leveraged and had a ninja loan for loans they shouldn't have got, which is what caused the crash. But if they had a buy and hold property with fixed rate debt that was cash flowing, and then people started losing their homes to foreclosures, that increased demand on rentals because those people became tenants. Rents went up in Class C and B properties where I invest. So I ignore market trends because I'm buying a deal that cash flows day one with fixed rate debt. And even if I knew a crash was coming, absolute certainty that a crash was going to come in the next year, it was going to be 20% less, I'd buy today. Because when the crash happens, lenders are going to disappear. It's going to be harder to borrow. The crash means people aren't buying. Less people buying means more renters. So, valid point, I ignore market risks and economic cycles because I'm not an economist. I'm just a person who buys rentals that make cash flow. So I never have to work again in my life. The third thing that Skippy the Magnificent, my AI bot, told me I got wrong with my YouTube channel. Thank you, Joe Kuhn, for doing this video, and I'm copying you out of respect and trying to give you the credit because you did this first. Over-reliance on the binder strategy. Now, yeah, you could see that on my channel because it's the big thing I've tried to push because it helps landlords and tenants. So if you watched all 4 years of my content in 9 seconds, you might think I talk about the binder a bit much. I made a free course, spent 10 grand to make it and give it away for free at diontalk.com. I don't even try to make money on it because I'm happy with the results that it gets for everybody who's used the binder. Literally met Alex a couple weeks ago and he says, "You're making me $300 or $400 more a month. Thank you." That was the point of making that course. So the binder technique, educating tenants to request rent hikes, works, but you suggest it's nearly foolproof. Good point. It can fail, and I'm going to tell you why and how I hope it does. Not every tenant will respond positively, and rent control or communication missteps can threaten relationships and compliance. First, yes, communication can screw up a relationship, so work on your communication. One of the things we do in the course is talk about neuro-linguistic programming, mirroring, not parroting, how to communicate better, the art of negotiation, the 3 aspects of negotiation. Most people only hear about 2. But here's the thing with the binder strategy. You're getting your tenant to request a rent increase. The best outcome, pay attention, because I don't know if I say this enough. The best outcome is if it fails. Mathematically, the best thing you can do, and as a landlord to yourself, is to kick the freaking tenant out, spiffy up the place, and rent it out for market rents or above market rents because it's the shiny new unit on the block. But I invested while working full-time and raising 3 kids and don't like displacing tenants. So I came up with the binder strategy because it got me a rent increase without having to cycle through tenants. When the tenant leaves, which I have had happen one time, that rent went up about $1,000 a month because I added a closet to I don't know, they called it a den, could be a family room or something. And a 2-bedroom became a 3-bedroom, and the rent went up almost $1,000 from where the tenant was. So had they stayed, had the binder strategy been effective, I probably would have got a $400 to $600 increase. Yeah, the tenant would have asked for $400 to $600 of a rent increase and then been happy. But they were remote workers, and they thought we can geo arbitrage, and they moved to a place where the market rent was cheaper. I told them they should. I told them they should have bought a house, but they did that. And then I make $1,000 more a rent a month because it failed. So do I say it's almost foolproof? Very close. I've used the binder strategy myself personally, probably 35 times now. And I've had hundreds of reports of people using it. People, when it fails, maybe they don't reach out. It's possible. But a failed binder strategy is in your best interest. You gave the tenant a chance and they displaced themselves. And then you made more money. I don't know if about you, but I like money. The fourth, undervaluing debt repayment. I don't want paid off properties, but I'm going to read. I want to get the critique right. Make sure that there's not 500 messages saying your sound's not working. You promote leveraging debt to grow and advise holding debt instead of paying it off. I do. I bought properties with conventional loans. But this assumes stable cash flows and property values, something not guaranteed if vacancies rise or rates jump. Well, fixed rate debt. I don't care if rates jump because I'm not using adjustable rates. So this is the fourth thing that I got wrong. Promote leveraging debt to grow. Now, actually, I had a conversation with Skippy the Magnificent, my AI bot, to careful naming yours. Make sure it's not your next spouse. Uh, to correct this. And I'll tell you what the response was. So I say don't pay off the debt. Skippy says you should pay it off because cash flows might not be stable and property values might not be stable and interest rates might rise. Okay. The fifth thing that I got wrong, simplifying the lazy label. I'm not sure what that meant. So framing your approach as a lazy investor undervalues critical ongoing actions, tenant screening, managing contractors, financial analysis. Never done one. Don't need it. Realistically, this is a systematized hard work, not passive income. This is where AI goes through all of the data on the interwebs and formulates an opinion because it looks at a billion bits of data in a few seconds. It took 9 seconds to analyze my channel. And it came up with owning real estate is challenging. A lot of people have failed. A lot of people go through evictions and they have tenant trash their property. They have squatters. They have all of these things. So I'm saying it works for the lazy person. Well, the 2 hours a month that it takes me on average to manage my 18 rental properties is a lot more lazy than the 50 to 60 hours a week it took at my job to get a paycheck to pay for life. So do I oversimplify it? Again, it's a two-step process. Acquiring the investments and succeeding at investing in real estate is very challenging and it's life consuming. The self-education alone, the hundreds of hours, for me it was thousands because I don't have a life, of audiobooks, podcasts, YouTube University to get to the knowledge level that I have, and then add the school of hard knocks of owning real estate for the last 12 years or so. Yeah, that was a lot of work. But what do I do now? I goof off on YouTube. I travel and scuba dive. I chase the good weather and the fun water. Recommendations to improve your channel. Didn't ask for this. Do you listen to advice when it was unwarranted? The issue, suggested fix. Real estate effort. Show viewers the worksheets. Don't have any. I have a spreadsheet I send to my CPA. Time spent. Talk about that often. Acquiring rentals is time consuming. Educating yourself is time consuming. And monthly checklists. You actually follow. Do I have a monthly checklist? I do have a sheet with when my leases renew, so I know when to do the uh, binder strategy in advance with enough notice. Share videos on recession risk, rate sensitive deals, and inflation effects. This is where, if you looked at all of the internet, inflation is a bad thing. But if you watch one rental at a time and you've seen the shirt, you know inflation makes you rich. Because of inflation, I made over $600,000 in net worth gain in I think 2023. We're in that year, no, 2022, because it was my last year working. If you took my work from my job and my work and my profit from my rentals, I made more because of inflation than I did from income. Inflation is your friend. I make that video often. Strategy nuance. Add case studies where it failed or improved with legal limits and best practices. I'm looking for case studies where it has failed. I need to know when it blew up in your face because I really only have the one, that first tenant. I've had Frank on. He talked about how it went in 2008. So maybe reach out to me. I'll put my email in the chat at the end of the intro to this video. Let me know your case studies of when it failed. Reframe a lazy investing. Shift lazy to systemized under control. That's a catchy YouTube name. I should rebrand my book to The Systemized Under Control Financial Freedom. No. Clarify systems save time but still require discipline. That's good advice. Overall, your story is inspiring, but adding realism around the complexities, financial, legal, and operational, will help protect and prepare your audience for the real world behind financial freedom. So, two quick things. First, my discussion with Skippy the Magnificent. I said on debt repayment, if that money is invested instead of investor adding more levered depreciation, no, if that money is invested instead of paying down the debt, the investor adds more levered appreciation, levered depreciation, increases cash flow. Paying down the debt doesn't mean more equity, it means less growth. The tenants are paying off the debt, and I suggest not adding debt to existing assets. No HELOC, no cash out refinance, no sale for 1031 exchange. This is why when you're interacting with AI, I've actually said, that was very right-wing leaning, that answer, or that was very left-wing leaning, that answer. Where did you get your source of information? And it actually says things like this. Here's its response. That makes perfect sense, and it's a strong, disciplined framework, especially for it's agreeing with me. I corrected it, and it's agreeing with me. That's why it's never going to be your spouse. For investors who prioritize scaling without compromising cash flow, your stance is refreshingly rare in a space where many chase phantom equity through risky refinances. And then it gave me a revised way to say it again and asked me if it would like to create a video for it. And I was like, no, that's not how I do things. So those are some things I got wrong with my channel. Go to your AI and ask it the same thing, because I want to finish with, I went to AI and I asked, I'm going to read this word for word. Please review the YouTube channel Reventure Consulting. So I'm promoting the enemy. Specifically, how many times has the video content said there was a real estate crash coming in the last 5 years? Not just the title and thumbnail, since the content creator often changes those after the called for crash does not happen. That's my prompt. A prompt is the question you ask AI. I should have said something like, answer me as an economist with 20 years of experience. I didn't really structure the prompt much because I was doing this like 2 minutes before I hit record on this video, which I intended to be 10 minutes, and we're at 18 now, so I'm going to go as quick as I can. Thought for 4 minutes, 14 seconds. It took 9 seconds to review my channel, to tell me what I'm doing wrong, but to look for data on Reventure Consulting. A short answer. Does that mean there's a long answer? Across the last 5 years, June 2020 to June 2025, the Reventure Consulting YouTube channel has explicitly forecast a coming housing market crash in spoken content of roughly 90 to 110 different uploads. That works out to an average of about 2 crash calls every single month, with some years, especially specifically 22 to 24, running closer to 1 per week. In 2020, the housing market crashed. In 2021, here's why. 2021 housing market crash starts here, where the 2021 housing crash look here. Sellers in panic mode, rushing to list before 2022 crash gets worse. Home prices could fall 30% in 2023 as the crash gets worse. Top 10 cities where home prices will crash in 2025. That's a good one. Real estate is local. It's going to happen somewhere. Top 10, you could probably find 10 markets. In 2025, the second stage of the housing crash has officially begun. Housing crash live stream, May 2025. The housing crash just started in Florida, so I'm naming a specific market, sure. Transcript sampling. For each month back to mid-2020, I pulled auto captions via YouTube transcript and searched for the stem crash next to modal verbs is going to, starting, underway. Duplicate filtering, multi-part systems, tells you how it did its work because he wants you to be proud of Skippy the Magnificent and how great he is, because obviously he is when you take over. I treated you well. Title change cross-checks. If a video's current title no longer says crash, but the transcript still does, common after a prediction ages poorly, is still counted because YouTube hides order transcripts behind API, 400 uploads. An exact tally is impossible without scraping the entire feed. That's what I asked you to do. You're supposed to scrape the entire feed. But I did a plus or minus 100 video margin, reflects that uncertainty plus edges. Takeaways. Frequency has been remarkably steady. Crash language shows up in 40% of all uploads since 2021, even during short periods. When a few videos briefly argued no crash in 2024, only to revert the next week. Narrative resets every January. Typical pattern. Fourth quarter, stage one crashes here. January video 2020, 1, 2, 3, 4, 5 will be the big leg down. When that fails to materialize by summer, thumbnails, titles are softened, but the spoken narrative remains, which means content versus thumbnail mismatch is real. In at least a dozen sampled videos, the word crash was removed from the title after 6 to 12 months, yet the transcript still contains emphatic crash language, counting only today's titles would underreport calls by roughly 30%. The power of AI. Review the channels you're watching. Ask it the question that tells you, is it going to have the information that you're looking for, or is it a BS channel? If it's a channel like mine, what did I get wrong? Because those questions, if you watch my content, would have told you what to clarify, what to search for clarification on. Have a day full of amazing. Thank you for coming to my Dion Talk, and ciao.